Fusion Mobile, quality e-learning experience on the go.
Yeah, welcome to Fusion Mobile learning platform. I'm Lokobi Kwelimi by name, commands to solve. And this class we'll be looking at the money market and the capital market. So we'll be looking at the definition of the money market, so instruments traded in the money market. We'll be looking at the advantages of the money market, and also institutions involved in the money market, and also we'll be looking at the function of the money market. Hereafter, we'll look at the definition of capital market, advantages of capital market, and also functions of capital market. And also we'll look at the similarities and differences between money market and capital market. Then we can look at the method of issuing securities. So the first thing we have here is the definition of the money market. So generally, the money market is the market for short-time loans. So it serves as an intermediary for those that are in need of funds, and those that have surplus of funds, those that want to lend the funds to the borrowers. So it's actually serves as an avenue in which short-time loans can actually be lend and borrowed. When short-time loans can actually be lend and borrowed. So it is the market where those that are in need of short-time loans actually meet those that are ready to give out their surplus. There is a surplus to those that are in need of it. So when talking about the market, so in the money market, we have different instruments that are traded in the money market. We have treasury bills, we have treasury certificates, we have certificate of deposit. We have a lot of instruments being traded in the money market. And again, we are going to look at the advantages of money market. Advantages of money market. So we have the advantage of the money market. So we have that is provision of finance. So finance is being provided to those that are in need of finance, to that in need of short-term fund, and also creation of extra income. So it's provide extra income for those that are with surplus fund, because those are actually gives to those that are in need of the money of short-term. For what happens, actually receive their fund with interest. So it serves as an avenue to earn extra income. And again, promotion of economic development. Through the end of extra income and the process, what happens, economy actually develops through that process. So it ensures and promotes economic development. And again, ability to recall invested funds. So a person that actually invests in the money market can actually recall the fund. Can recall the fund during time, and also because it's of short time period, and again enhances savings. It helps to enhance savings habits among the people of the country. And again, we are going to look at the institutions involved in the money market. We have different institutions that are involved in the money market. We have the Central Bank of Nigeria, we have the acceptance houses, we have the discount houses, we have the commercial bank, we have the insurance companies. A lot of institutions actually we have the finance houses that are actually involved in trade in the money market. So some of them regulate the money market, the activities of the money market, and some of them serve as intermediaries in the money market. So they actually serve as intermediaries. They're the one that regulate the money market. Actually, we don't have the physical market for money market. We just have as an intermediaries of traders that actually links those that are in need of short-term funds, and those that actually have surpluses that want to gives to those that actually need this short-term funds. So we don't have the physical market for money market. So you should know that. And again, let me mention those institutions again. So we have the commercial bank, we have the Central Bank of Nigeria, we also have the acceptance houses, we have the finance houses, we have the discount houses, we have the insurance company, and so on and so like that. So let's look at the function of the money market. The functions of the money market. What are the functions the money market provides? So number one is that it's provision of short-term loans to those that are in need of loans. Those that are in need of loans. So the money market enables those that are in need of short-term funds to be able to secure such funds. So money market should be ensured that there's provision of short-term loans to those that are in need of the loans, and also it encourages investments. It encourages investment since it's provided an avenue in which someone that have a surplus fund will be able to lend to those that are in need of surplus fund. So it encourages investment in the economy. And again, effectiveness and efficiency of monetary policies. Wow, it helps to ensure that there is an effective and efficient of monetary policy, and also it facilitates transfer of funds So they help to what facilitate. That's one of the what functions of the money market. And also the use of surplus funds. So it helps what those are what that actually what have availability of what surplus fund. So that have ability of what surplus fund to be able to what to use this surplus fund in an effective what use, that will give those that are what that are in need of such surplus fund, that to those that are what that have the deficit fund, to give to those that are what in need of surplus fund in return for what for interest and what and amount of the what surplus fund. So it's the use of what surplus fund, intentional effective use of surplus fund. And also provision of liquidity and safety of financial assets. Wow, the money market also ensures what liquidity and what and safety of financial what assets, since such financial assets are what and of short time period. So it helps to what ensure what liquidity and what safety of financial assets, since what this is the money market where short time knows, so I mean a short time period within what maximum period is of a year. So we have within 2 months, a month, you understand, weekly and something like that, based on the what instrument traded in the money market. So it ensures what liquidity in the market, liquidity and also what safety of financial assets. So the next thing we are going to look at is the definition of capital market. We are going to look at the definition of capital market. So capital market is opposite of the money market. So this is the market with those that are in need of long-term fund actually what comes together to actually what secure such a fund. So those that are in need of long-term fund actually mean those are what that have a long-time surplus fund to give out. So this is the market that actually link those that are in need of long-term fund and those are what that have the availability of this what long-term fund. So this is what it serves as a link between the giver of the long-term fund and the borrower of long-term fund. So it serves as a link between the lender of long-term fund and what borrower of long-term fund. So this is where this market in which long-term fund is being traded. So we have advantages of the capital market. Is that number one is that it ensures to what is provide long-term fund, provision of long-term fund. It also ensures mobilization of savings. Wow, it ensures mobilization of savings, and also it's growth of merchant banks. Since majority of the merchant banks trade their capital market, so it helps to bring growth about merchant banks, since they receive majority of their profit and returns from the capital market. So what happens? It ensures the growth of merchant bank, and also it ensures general running of the economy. So yeah, it ensures the effective running and of the economy. So general running of the economy is well okay through the capital market. And also we have the function of the capital market. We have the long-term fund mobilization. So you have to ensure that there's mobilization of long-term fund, and also there's avenue for lending and borrowing. So those are what in needs of deficit fund can easily come to the capital market to secure a long-time loan from those that have surplus fund. So they will serve as an avenue for must provide an avenue for lending and borrowing. So that is also the function of the capital market. So the capital market must actually provide avenue for lending and borrowing, and also channeling of funds to productive investments. You must be able to channel funds to a productive investments. So you're able to when the fund is being channeled, so you're going to ensure that such a fund that are invested in a productive way. And also economic development and growth. So that will be it ensures economic growth and development. The market ensures economic growth and development. And again, there is government can borrow long-term capital from such markets. So government can actually borrow long-term capital and long-term fund from the capital market. So we have now similarities. Okay, well, let's look at those the instruments traded in the capital market. There's a lot of the instruments being traded in the capital market. Okay, basically we have 3 instruments now. We have 3. We have the shares, that is equity shares. We have share or preferred shares are being traded in the capital market. One of the instruments traded in the capital market. We have bonds. Bonds are also traded in the capital market. And again, we also have we have debentures being traded in the capital market. So we have shares, we have bonds, also we have debentures being traded in the capital market. So these are the instruments traded in the capital market. And also let's talk about the institutions that are in the capital market. The institutions in the capital market, we have the central bank, we have the stock exchange, we have the Central Bank of Nigeria, we have the stock exchange, we have the investment banks. Different categories of investment bank are also part of the institutions in the capital market. So we have the stock exchange, we have the Central Bank of Nigeria, we have different categories of insurance companies also trade in the capital market. So we have the similarities and differences between money market and capital market. So similarities between money market, let's start the similarity between money market and capital market. Okay, both money market and capital market actually provide an avenue whereby someone can borrow funds. So provide an avenue where funds can easily be borrowed. And also, both money market and capital markets enables lenders to direct their funds, so to direct their fund for investments. So what happens? Those that have surplus funds can easily go to either of the markets, like capital market or both money market, to direct their funds or to lend their funds to those that are in need of such funds. So, and also, both market this with financial assets. They both this with financial assets. So let's look at the difference between money market and capital market. And the difference between a money market and capital market is that the money market deals with provision of short-term funds or short-term loans, while the capital market deals with provision of long-term loans. Also, the difference of money market and capital market is that the money market usually lasts between a period of 1 year, less than 1 year, that is the maximum period in which the asset being traded in the market can last. And the capital market usually more than a year. And also, the risk in the money market is always of low risk, while the risk in the capital market, is very high. Very high risk. And also in the money market, what happens? There is low return. There is low return of investment, since it is short-term loans. And in the capital market, there is high return of investment. And when there is high return of investment, what happens? There must be high risk. So the next difference between the money market and the capital market is that the instrument traded in the money market includes the treasury bills, that's certificate of deposit or treasury certificate, while the instrument traded in the capital market includes the shares, the debentures, and the bonds are traded in the capital market. And also in the money market is that the institution that actually trade in the money market includes the acceptance houses, discount houses, the commercial banks, while the institution that trade in the capital market includes the stock exchange and the Central Bank of Nigeria, and also the investment bank. These are the major differences between the money market and capital market. Now, let's look at the new issued market. So we also have some aspect of the new issued market. The new issued market is also the part of the capital market in which new issues of shares are sold and bought. So it's a portion of the capital market when the new issue of stock actually sold. So this market includes the issuing houses, you understand, and some aspects of discount houses. So the new issued market actually enables new issued securities. The new issued security will actually be sold. This security includes shares, stocks, bonds, and some form of debentures. So they can be sold in the new issued market. So new issued of security that are sold in the new issued market. Now, method of issuing security. So security can be issued by different ways. Now we have the private placing. Security can be issued by private placing, also by introduction, also by through right issues, also by tender. Can also be issued by tender. And also by prospectus. So we have private placements or private placing or placement by introduction, right issues, tender, and prospectus. So when issued when shares are issued by private placement, this usually deals with new security. So when shares are issued through acceptance houses or discount houses or issuing what houses. So this actually what these issuing securities are what actually sold through the what to the issuing houses or discount houses. So this actually deals with what new issued of what security. This what is new issued of securities. So whenever there is new issued of security, all of these shares will be given to the what will be given to the what the issuing houses or discount houses to what to have the shares sold to the what to the member of the public for subscription. So because such method of issuing security as what as private what placing as private placing. So the money from private placing actually goes to the companies which actually what issuing such securities. So the next one we have is by introduction. So this is when the shares issuing of the shares actually is introduced to the what to the stock exchange. So this actually deals with what issuing the what of existing securities, the issuing of what existing securities, and this is taken to the floors of the stock exchange. It's taken to the floor of the stock exchange, to the floor of the stock exchange. So actually the money actually received from for shares issued by what by introduction does not go to the company but goes to the what to the owner of such shares, the shareholder. Now the right issues, this is actually what issuing shares to the existing shareholders according to the proportion of the share held. So giving the shares, issuing shares to the what the existing shareholders in proportion of the what of the shares they actually what have. Now by tender, share can also be issued by tender. They are issuing shares to members of the public by asking them to tender their prices, and what the shares will be issued at the price called the striking price, that is the higher price bid by the member of the public or by the subscriber. So each subscriber of the shares will have to tender their prices, and what happens, the company is going to issue such shares at the price which actually beats the market, which is usually refers to as the striking price. And also we have by prospectus. Share can also be issued by prospectus by inviting the member of the public to the prospectus of the company. So inviting member of the public to actually subscribe for the shares of the company of the company. So the member of the public will be invited to what we term as prospectus. So this is about what as an invitation. So inviting member of the public to subscribe for the shares of the company. So these are the methods in which shares can be issued, in which securities also can be issued. So we have by private placing, we have by introduction, we have right issues, we have tender, and we have prospectus. So it has been an interesting class. You are able to look at the definition of money market. You are able to look at instruments traded in the money market, like treasury bills, treasury certificate, and the certificate of deposit. We are able to look at advantages of money market, institutions involved in the money market. We are able to look at that. We are able to look at the function of money market. While also we are able to look at the definition of capital market. Thereafter, we move to the advantages of capital market, function of capital market, similarities and differences between money market and capital market, and also we are able to look at institutions that are found in capital market, and also instruments traded in the capital market. Also, we are able to look at the method of issuing securities in the capital. After method of issuing securities, where we talk about the private placement or placing, where we talk about the by introduction, issues, tender, and prospectus. So if you have any confusion or as regards to this topic, or you want to have a more better understanding about the topic, do not hesitate to replace the video, and also some exercises will be displayed on your screen. Do well to attempt such exercises. Thank you.